Welcome, everybody. Yeah, it has been quite a while. I think our last note, which was oversubscribed by I think 160%, was at the back end of February. And for those of you who are on our sort of mailing list and our WhatsApp group list, please feel free to join at any stage. We've been sort of sitting on the sidelines watching events around the world unfold. And being a community which started as family and friends, investing for our own money and our own children's money, we've adopted a sage approach. Now, it's been quite interesting in terms of watching this noise unfold on a day-to-day basis, both geopolitically and as well as what the markets have been doing. And it's taken us, a good, I would say, 10 weeks. And we've been busy. We haven't been lying on the beach, but we've been busy looking at different options, looking at what might work at certain entry points. And it got to a point where sort of probably about a week ago, 10 days ago, certain things started falling into place. And we started talking to our structurers. They started talking to the investment banks. There was a lot of backwards and forwardsing. Believe you me, we'd make Wimbledon look tiring, going left and right and looking backwards and left and right. But we are delighted to have produced a note that we feel is resonant for the times, that has reference for the two major risks that we feel, there's a lot of risks, but two major theme risks that are actually evident at the moment. So, the halo word was not coined by myself. It's actually a 2026 sub-theme, and we'll get into that a little bit later. Joel's giving you a little bit of the sort of flex of what is going to be shown tonight. It is income. It's in both currencies. We're very, very and super chuffed to have brought it to you in dollars and sterling, because we haven't had a sterling note for quite some time. And there's been quite a few clients who are saying, when is a sterling income note coming? So here you have it. It is paid semi-annually, and it's quite a short window. Bottom right, you're looking at closing time 19th of May on Thursday. So it's not a long time to get your money cleared. If you need to open a platform, speak to the guys, we can help you. But we've got to move on this quite quickly. The banks also, because markets are moving quite irrationally and rationally, and I'll explain a lot of that later. I think this is a record for me. I personally think I've got about 19 slides, but I'm going to move through them quickly, and hopefully they all hit home in terms of what we are trying to show. And that is that it's a world of risk at the moment and uncertainty. And I think we can all probably put our hands up and say, you wake up every day and you're not quite sure where the trajectory of markets, or in fact of the world, is going at the moment. So that in mind, stunning coupons. Thank you, Graham, the team at IDAD, to regular sort of arm wrestling with the various investment banks. And we were delighted to have a number of investment banks very keen to underwrite this. They like the concept, they like the thinking and the rationale. And hopefully, if you did see the earlier invitation that we had an hour to go, there's a rationale link there. Have a look at that, because it goes into a lot more detail, probably makes a lot more sense than I do at the end of a working day. But it gives you some granular sort of context of why we are doing this. So let's move along. When I was growing up, on a Sunday night, I think it was Bubble and Squeak. I had English parents, and it was sort of leftover vegetables that were fried up with some yummy stuff and put on toast, and it was basically the folks' way of getting rid of food before Monday started. But there are two major risks that are trending at the moment. Obviously, there's a heap of others, and they're all interrelated, they're all interconnected. And that's what we have to realize. You cannot just isolate into compartments or silos risk profile. So this covers a vast range, but we have focused, because of the note, on these two sort of risk trends that are trending at the moment. And per the rationale that I mentioned, the one is the artificial intelligence super cycle, perhaps bubble, that was really the talk of the town and all over markets February 27, when the war kicked off in the Middle East. Let's not forget there's another war going on which is causing major problems in Eastern Europe. But certainly that is something that has really come to the fore. Now, this presentation in the main is going to deal with that. Okay, I think we are so probably saturated with information and knowledge and theories and conspiracies and information about the second risk, which is the Middle East conflict and I call it the economic consequences, but let's cut to the chase. It's all about energy. It's about gas, oil, crude oil, petroleum, and how we move forward. So to Matt's point of driving 6,000 kilometers, 6,000 miles, I'm not quite sure you did it probably before the real price increases came through. But yeah, I think we can talk about that and let me cover that. It is in the rationale. It's, outside of tech at the moment, which is really the first risk, geopolitics is really driving the headlines at the moment. Tensions in the Middle East are swinging between escalation, de-escalation, and oil prices are literally moving with every single update we get. I can't keep up. I keep a couple of TVs on at the offices, and I walk past them and the different channels, and I stand and I stop and I get mesmerized. I almost have like purchasing paralysis. Which one did I buy? Which one do I look at first? But markets, I think, especially in the last day or two, and it's been a sort of theme where there's a lot of pressure on the parties to come to some sort of a coalesced agreement. There seems to be an increased betting on the fact that the US and Iran are going to ultimately reach, hopefully, some type of agreement as opposed to going into a whole major ground warfare. And it really centers around what I've been banging on about in my weekly wraps, in my updates, in my insights, is around this choke point that is so well covered now, the Straits of Hormuz, which is really the energy shock choke point. And it's not finalized. There's more chatter on TV tonight. There's more chatter on Bloomberg and Reuters and everything about we're close, we're not close, etc. But I think historically what's happened, investors kind of historically have moved past these geopolitical conflicts pretty quickly, unless in this instance energy prices really have spiked hard. Now they went up to $125 a barrel. They've come down again on the narratives that we're getting close to peace, etc. So for now, crude oil, which is basically the major input into what we call, the Americans call gas or petrol, etc., is kind of manageable. We're not happy about it, believe you me. I mean, South Africa, a lot of people on this call are from South Africa, had a huge price increase this week. I was speaking to a friend of mine in Texas this afternoon, I beg your pardon, yesterday afternoon. And he said the average price is around about $4.50 for the American consumer. I said, really? He said it's been the highest since 2022. Okay, so that's 2 years after COVID. And there's only 3 states in America, okay, and they're one of the protagonists in this war. There's only 3 states that have average price below $4, and they're all sort of Gulf states where probably the processing price is a little bit cheaper because there's no transportation. So it's Mississippi, Louisiana, and Oklahoma, okay? But in average, American gas prices have gone up 50% since the start of the war. So DJT, as I refer him to in most of my insights, is facing midterm elections, and Americans like their big V8s, their big trucks. So it's hurting them in the pocket, and it's tricky. And even if the straits get sorted out tomorrow or tonight or whenever, energy prices, I think most economists, most people, rational people who even watch TV, as a casual bystander, realize that it's going to take time for energy prices to retreat to pre-February 27 levels, because simply infrastructure has been damaged, has been compromised by strikes all over the Middle East, etc. There's also the interesting situation of the UAE having pulled out of OPEC, but that's a different discussion. So, it's going to be a while that I think we're going to be stuck with these levels, and that's going to filter into our lives, and it's going to filter into the lives of people who make interest rate decisions for us, like the Federal Reserve, the Bank of England, the Reserve Bank of Australia, the Reserve Bank of Switzerland, South Africa, wherever you are. We have this energy shock. So that is a risk that we needed to look at in terms of structuring this product. How do we deal with that in terms of where is a company still going to be profitable with this sort of background? Okay. So most of this presentation, a lot of this presentation is around about the AI bubble, which was existing before. People were concerned about it. And there's been a lot happening because it's earnings seasons. My big thing is earnings, how companies are doing. It sort of reflects inside their DNA, what's going on. And it's been really interesting in terms of this AI trend. So let's gallop on to the next one. So if I look at the next slide, if we look at US markets, for example, gearbox of the world, engine room, biggest capitalized markets in the world, the three big indices, S&P, Dow Jones, and NASDAQ, are breaking up to all-time highs or intraday highs literally on a daily basis. This against the backdrop of what I've just described, of this doom and gloom and rockets going off and missiles and drones and drama. So the tech theme within US markets has been phenomenal. And there's a couple of charts we're going to take you into, which will just actually, it really does exacerbate and exaggerate how well technology has done in terms of certain sectors. Now, what I want to show is that not all technology works. You can have the best results in the world and you get punished. It's the weird thing. It is really weird. You can have two companies, same results, great results, should I rather say. One gets punished, one doesn't. Why? It's an interesting disparity about that. But the US markets, we're coming to the end of the earnings seasons for quarter one. And as I said, 3 quarters, we almost finished this week. This was sort of, some of these slides were put together probably 2 or 3 days ago. It's been quite fast moving. But 3 out of 4, so 3 quarters of US companies in the S&P have beat their analytical estimates in revenue, in terms of profits, in terms of earnings, which is phenomenal. As I said in some of my earlier insights and weekly wraps, you know, the war started on the 27th of February. We had March, which is the end of the quarters. You only really had one month where negative things could have been feeding in. It probably comes more into quarter two. So my suggestion would be that you'll probably see the next quarter's earnings, which reflect on quarter two, would probably factor in a little bit more pain in terms of where people are saying, we need to revise estimates. This is hurting us. This is not hurting us. I mentioned the price of fuel in those, you know, in the States, besides the 3 that are below $4, it's going to hurt. Okay. So, yeah, it's something that we need to keep an eye on. Earnings are I would say, a more finger on the pulse in terms of how that company is doing. And what's important, you need to realize it's a backward-looking metric of what we did last quarter. What's important is the guidance from the CEOs in terms of what are we going to do in the future. And if you look at the top right-hand side, 5% of companies is going above consensual estimates in terms of they are beating the tracking that the analysts are saying they're doing. And back to 21, that's 25 years, that's a quarter of a century. The average has been 3. So this has been a very, very strong boom period, end of 25 into 26, irrespective of the fact that a war was started on the 27th of February. That's going to still feed through. It's leads and lags. It comes through in waves. And some of the surprises will come through. But yeah, it looks quite healthy. The American sort of markets look quite robust. We have the jobs report, which is something else I focus on in terms of US employment. Are we employing? Because if we're employing, we have to fill spaces because we've got orders. That comes out this week. And it's still looking robust, although with these prices of fuel going up, they might say, hey, we need to temper that. So it's a little bit of swings and roundabouts at the moment. There's a little bit of indecision, so we can't exactly predict on that. But let's look. I mentioned earlier about not all stocks get rewarded whether you have blowout results. Have a look at these two. So a bit of an apology to Charles Dickens and A Tale of Two Cities, which I hated reading at school, but I had to. I call this A Tale of Two Stocks. So here we have Palantir, okay, a software company. These are all listed in the US and on the NASDAQ. And here we have AMD, Advanced Micro Devices. These are both companies that Cashbox has used in many notes successfully, particularly AMD, which is really a peer of NVIDIA, the most powerful and probably the most capitalized and biggest company in the world at the moment. But let's have a look at them. They both had their earnings. They were reflecting back, as I mentioned, to what they did in quarter one. And they both had knockout earnings. But now look at those two charts. The one, okay, and this is literally a week. This is a week's snapshot. Okay, I actually took this off my iPhone, nothing fancy. I just did it quickly. And the clever guys at Cashbox put it together. They said, we can do fancy charts. I said, no, this tells me a story. One is in red and one's in green to start with. One's going down and one's going up. They both had knockout reports. So why did that happen? And I'm just trying to find my notes that I made. Okay, so let's have a look at Palantir. Okay, their earnings came out. They roughly did 85% revenue growth. They did 150% earnings growth. They raised their full year guidance in terms of our order books are full, guys. We've got money coming out of our ears, so to speak. And they closed, listen to this, 206 deals of worth at least $1 million each in quarter one. That's $206 million worth of deals signed. They would make most business owners quite happy. And you'd think, okay, you can probably see there, it's got something called a PE ratio, 154. That's probably a big red flag. It certainly is to me. In a risk-off scenario, which is a note scenario, where we're trying to protect clients' earnings, price-earnings ratio is very crucial. 150 is massive. It's massively high. Okay, it's extended. The same goes for its compatriot on the right-hand side, 140. These are very, very elevated because there's been such a surge into tech. Okay, but now why did the one go down? And I'll talk to you about AMD. Why did it go down so rapidly? Well, it's quite interesting. Palantir is a software company. One of the areas that was raised with the advent of AI was who they're going to put out of business, who's going to lose jobs, who's going to lose contracts, who's going to lose business. Okay, and software is perhaps one of the areas that is under target. The chip manufacturers and everybody say, no, all is good. But there's this fear that this might happen. So over the last year or so, and this is only, this is literally a short period. This is 1 week. Investors have started developing probably something close to an allergy, if I can call it that, towards profitable cash generating software businesses. Simple as that. It sounds counterintuitive. But they've been driven by this single uncomfortable question of, has AI introduced into the boardroom and every earnings call? What if the software gets replaced by AI? So there you go. There you have it. That's the nub. Okay. We can do something better for you. Okay. So the biggest players in AI at the moment, with respect that, I'm not an AI person, is probably OpenAI and Anthropic. And they are now knocking on the doors, the corporate doors of every client of Palantir, offering something faster, cheaper, and increasingly probably capable of doing the same, translation. And that threat, even if it remains years away from being real, is enough for investors to quietly wonder, I wonder if Palantir is the last generation of this kind of software, rather than the first generation of the next one. So are we seeing the old being replaced by the new? Where do I go? And, it's a brutal place to be. I mentioned those numbers. When all the metrics are going up, your share price went down. It wasn't comfortable. You look at AMD, completely different vibes, if I can call it that. They popped in extended trading. They soared 18 point. That spike there represents about an 18.6% increase in 1 day on their posted earnings and revenue that topped all the analysts' estimates. Okay, their data center, and this is the big one. The data center absolutely surged. Okay, accounting for more than half of their total revenue. So they are hugely reliant now on the AI trade working. So the tech issues are highly complicated. They're very involved, but you can see there's a risk premium. If you'd been sitting in Palantir or AMD, which one do you choose? How do you choose it? They've got similar PEs. They've got great earnings. And yet one gets slaughtered and the other one rises like a balloon. So there's a lot of risk in the AI. And back to the first slide, there's risk, and we are trying to move away from risk for our client base in this note. So, moving on to the next slide, we spoke about how things are going. Have a look at this slide. I've called it the wow factor. It's all about tech, which it really is. If you look at the MSCI World Index, that's the Morgan Stanley Capital Index. Morgan Stanley is a private company. They do a lot of data analytics, but they put together an index representing, broad America, etc. And then you have the S&P, the standard, because the 100 largest companies in the States. They're pretty flat. Okay, this slide, with respect, was put together yesterday. Things may have moved. So you're thinking, well, okay, that's been an up and down. We can see where the war started at the end of April. Things were getting a bit wild. What's this green line? The green line is it's the proxy for tech. It's the S&P semiconductor ETF. It's a unit trust. It's a mutual fund, whatever you want to call it. But look at that performance. I mean, you 57, 60% today, I think it is. Whereas you languishing at 6 or 7 currently, I think, since the beginning of this year. This is a year-to-date chart, okay, starting in January. So if you'd put, $100 into an S&P semiconductor, you'd be looking rather clever. But that just shows you the divergence between one particular sectoral theme and where the general market is going. So what is dragging that market? It's the semiconductors, it's the microprocessors, the techs, but not all tech. It's some of the tech. It's basically the AI. Anything that's got an AI pulse at the moment, people are jumping on it, beating it to death and saying, please, can I invest in you? Okay, so it's a bit of a frenzy. So who are these guys that are pouring all this money into the market? So the next slide shows exactly, we benchmarked it back to literally 1 year ago. It's quite a busy slide, lots of colors there. Sit back and have a look, but it's got your big protagonists, the so-called hyperscalers of the AI world, of this artificial intelligence theme. So we've got Meta, which is basically Facebook. We've got Google, which is Alphabet, Microsoft, Tesla, Amazon, and NVIDIA. Now, some of those are not true hyperscalers, not true AI businesses. Take Tesla, it's a car business, but it's moving heavily into robotics and space and chip manufacturing, its own, etc. But look at those trajectories of those charts. Okay, and it comes with a big risk premium. As I said, these companies go up and down quite quickly, and in terms of their price valuations and their direction. Obviously, top of the pops you have Google there, Alphabet, and right at the bottom you've got Microsoft and Meta, Tesla, Amazon, NVIDIA. Okay, so these are all sort of household names now in terms of the space. But you've got to wonder. You take a company like Meta, and I mentioned this in one of my weekend posts or an insight. Meta's earnings, again, I'm back to earnings. I always look at earnings. Earnings were great. They're doing well. They're selling advertising. They're doing exactly on their cloud space and their infrastructure space and their training space. But Mark Zuckerberg, their CEO, had a very, very casual sort of take on in terms of what they were going to do with the odd $125 or $145 billion that they plan to spend in artificial intelligence. It was kind of lackadaisical, it was kind of relaxed, but it was on an earnings call, which people dissect the DNA of every single word, and they slaughtered the price. It went down 7%. But that had great earnings. 7% on the day it went down. Because he kind of said, and I read it, if I can read it too, I actually printed it out because I can't always remember. But I put it in my, it was either a weekend note or insight. It said, I don't think Meta has a very precise plan for exactly how each product is going to scale month on month or anything like that. But I think we have some sort of sense of the shape where things would need to be. That's pretty airy-fairy. Analysts didn't like that. They said we need to have plans, we need to have payoffs, who's scaling what, which product is going to earn what. We need metrics. And he came with this airy-fairy kind of thing, and the narrative killed him. Or killed the price on that day. So one has to prepare for this. But these are the titans that are pouring huge amounts of money. Now, if we go on and we look at how much money is being spent in this space, on the next slide, and I'm not a killjoy. AI is here to stay, believe it or not, but it has questions, and we'll get to that. So how long is a piece of string, I've called it? They're war chests. Okay, last year they spent $400 billion. This year, they pretty much doubled it up to nearly $700 billion. And there you can see the big spenders. Okay, there's the Meta I just spoke to you about, with Zuckerberg's sort of off-the-cuff comment. You got Amazon with 200 billion, Google 180, Microsoft 144, and then you see the smaller players who are lagging. I mean, Apple have got a big problem in terms of they need to actually do something about that in terms of their iPhone sales, which is their main driver. But there's Tesla. NVIDIA, and I'll talk to that, I call it capital light. NVIDIA doesn't need to spend money. They're a chip manufacturer. They're a semiconductor chip manufacturer. They've actually built the road on which all these other companies are now driving on. So NVIDIA doesn't really need to go into this massive overspend. They're just providing the framework for these guys to work in. And Oracle is quite interesting because we've seen Oracle in various notes. Oracle has, it's got a long history. I put it there as 50 billion. It's not one of those are all Magnificent Sevens, the so-called Magnificent Seven. I think, why is Oracle there? Because Oracle has put a fairly chunky amount of money in, and Oracle had the most amazing share appreciation last year. And then subsequent to that, again, it's a tech company. It's in this AI space. It's making masses of money off AI, but that money hasn't been paid yet. Okay, the contracts are signed, but the money hasn't flowed through. And therein lies the problem. So what these AI companies are all saying is that irrespective of people's concerns, because the concern is, when are these companies' investments going to pay a return? In other words, their share prices are going to go up and all their customer prices are going to go up because of reducing costs, expanding output, and raising real revenue products per that last couple of lines at the base of the slide. That's what they need to produce. And only 1% of companies is actually mentioning it in their earnings. So what's AI doing for them? But people are spending money and companies are investing, but we're not seeing the truth rate. And that's the bubble question, is that how much money is being spent for the type of return, and when is that durability of the return going to come back to you? So let's have a quick look at Oracle, because it's quite an interesting case study. So we've done AMD and we've done Palantir, none of which are in my in this note of ours. But here's a lesson in skepticism, as I call it. You can see the chart there. It's a 1-year chart. You can see the share price surged in September, up by 36% on the 10th of September. And it reported a staggering, I think it was 360% increase in backlog orders. In other words, it has got this sales book full of orders, 360%. So it's got years of so-called revenue in the wings waiting. Every businessman, every business owner's dream to have your order books full for that long at that level. And it was literally driven by its massive AI contracts that it had primarily with, in AI training, primarily with ChatGPT. Okay. So fantastic. The market went crazy. They reported this. It went shooting up 36% or whatever. But look at the chart since then. Okay. Depending on where you'd entered Oracle, if you were buying it as a company, you could be looking at a lot of red at the moment. If you'd entered it in May last year, you've made a few pennies. And if you bought it on the way down, you're in for a bit of a ride. So it's a company that has been directly affected by the volatility of this so-called AI trade, where people are questioning. Now, why did the fizz go away? Because that was huge fizz, which should have just kept going. But the fizz went away because primarily, and pressure remains into 2026, you can see it there. The skepticism regarding the existing debt that ChatGPT owes them. Okay, so they owe them almost like 360%, whatever. And how are they going to fund it? Okay, so they're relying on one company, basically, OpenAI, to fulfill its contracts and fulfill its deeds and fulfill its payments. So they're pretty much tied at the hip. And I think a lot of people on this call are married. Things can go wrong, and then there's a problem. So the banks also, who have to source the funding, are running out of their lending exposures. They can't lend anymore. So to fund these deals is becoming more and more tricky. So the AI trade can reverse very quickly, without literally sentiment getting involved. People look at the cold numbers. They say, is this possible? I'm taking a little bit of money off the table. So tech has wowed everything, but not all tech has wowed. And these are all household name companies. These are all S&P giants. I mean, these are massive businesses. But it certainly highlights the the balance sheets of what these people are putting in, and how much are they going to get back, and when is quite important. So I call that the yo-yo of Oracle. So let's go ahead. Who remembers January last year? A little company called DeepSeek arrived. This is another threat to the AI. This is another pinprick to the potential balloon or the bubble that we face. Late January, Chinese DeepSeek came along, unannounced, unheralded, very quietly rolled out its solution, and it caused a major, as I mentioned, the temporary rout. I mean, look at those numbers. $1 trillion got wiped off the Nasdaq in one day. Nvidia lost 600 billion of that. That's massive. That would kill most companies. Okay. Nvidia is the major, as I mentioned, the major engine room in terms of the hardware that goes into the AI. 17% on one day. Pretty heavy. Yes, there was a recovery and it subsequently recovered, but the shockwave that came through, and I would suggest the structural moat that still exists can still be penetrated. Okay, so it was the largest single loss for any company in the history of Wall Street. And it wasn't just Nvidia; it was right across the whole that semiconductor chart that was shooting up. Go back and have a look at January. Everybody took a big blood nose, and it was quite hectic. And the questions were raised were, why did that happen? Who remembers DeepSeek? What happens? And the next slide is actually quite interesting, because it's juxtaposed before the actual reasoning I'm going to give you. Next week and the week after, Trump is meeting the Chinese leadership, okay, against this geopolitical war. But it's also about they need to look like we are global leaders. We're in charge. Let's balance the short-term economic alignment with deeper geopolitical stuff. But this AI thing is still there. America has they have the Army, the Navy, the Air Force, the Marines, and now they've got a Space Corps. Okay, it's a new thing under their new Secretary of War, Pete Hegseth. They've created a Space Corps, which is basically AI. It's cyber war, cyber security. It's that whole futuristic concept coalesced into one department of saying, how do we become dominant? Okay, and no doubt the threat of Chinese artificial intelligence, of their production of what happened with DeepSeek, could that be a pinprick in the blowout numbers of Wall Street that we're both putting in terms of capex, capital expenditure, and what they hope to get out someday? Because if you lose $1 trillion in one day, that's quite heavy. So what caused that panic? What caused the world to go into like oh my world, that's the end. The next slide sort of says it all. It was, DeepSeek came along, and I think at the end of the day, it had its flaws and it had its operational limitations, and it was subsequently unpacked by all the propeller heads and the boffins, and they said this doesn't hold a candle. But at first glance and at first blush, it certainly did. And the biggest concern that it had was a comparable US counterpart or peer would cost $100 million to produce. They were producing it for $5 million. Isn't that a story we've heard before? We'll do it faster, cheaper, and deliver it, and it'll be the same competency. So a big problem, and it caused a big ripple on Wall Street, in tech and right across other sectors as well. So this fractional costing is a problem that could come along. And interestingly enough, since then, we haven't really heard of DeepSeek. It's all about OpenAI and Claude and this and that and the next thing, all of these fancy names. But what has happened to Chinese AI? It's retreated. It's gone behind literally the wall, the Chinese wall. There's a lot of structural constraints within Chinese AI where, the chip supply from America, NVIDIA is one of them, Taiwan Semiconductors as well from South Korea. There's a whole, again, it's integrated. It's kind of all mixed up, and there's complexity and difficulties in terms of unpacking it. But the Chinese have very much said, well, we need to own everything we make. We will control everything in terms of the input into that product. We will not be reliant on a third party. So they've taken a step back. It was almost like firing a shot across the bows of another ship to check the demeanor of the other crew. They saw what happened. They've gone back. And interestingly, Meta last week or the week before tried to buy an Chinese AI startup company with significant new technology. Chinese government stopped it. So there's definitely, I would say, something coming. And I think the meeting between Trump and the Chinese premier, they'll probably say, we will be getting on a par. They do everything on a par or to better. So the question lingers, will there be another deep seek, whatever it's going to be, moment where it totally rattles the American market? So the structural threat to those guys who are pouring billions and billions, 700 billion, could be quite profound to the shareholders in time if there is an alternative to what we possibly could be looking at. So let me summarize the artificial intelligence, because I know time is moving on. And the next slide kind of puts it into sort of 4 boxes. Is it justified? It is frenzied. I've used that word before. It's frenzied. Is it justified? Does it warrant a shareholder to say, well, I'm going to buy Meta or Google or these other companies at these elevated prices with these huge price earnings stretches? But yeah, the bottom left, tech amounts for 55% of total US business investment as part of GDP now. So it's huge. You cannot disregard that. And this particular note has not seek to disregard AI. I'm not shooting AI down. I'm just saying I'm putting AI into a position where we can look at it in context and balance the risks that could eventuate through something like a DeepSeek or something else, with something that would, with a theme that could basically be durable. And that is the whole tenor of the rationale. Investing in durable companies that both optimize AI, beg your pardon, not ID, AI, as well as being durable, that if there is some sort of a meltdown in those hyperscalers or something like that, they are still going to carry on and do good business. I've been over the questions of return. When are we going to get our money back? When are we going to make a profit on this investment? It's narrow. I mean, it's a bit like 2020 when we came out of COVID. The indices were sort of rubber banded out of there by, when I say rubber banded, it was like a boing, out went the rubber band by tech. It's a little bit like that, but it's broader. It is starting to spread. It's definitely starting to spread. So, but is it durable? How long will it last? And there, the Chinese question, how long will it take and when will we get there? So how do we deal with this? We've called it Halo. Well, we haven't called it Halo. Halo is actually a trend that's been trending in 2026. It basically the acronym stands for hard assets with low obsolescence. So something that's not going to go out of favor quickly overnight, something that needs to be in place for some years, that won't be easily replaced by artificial intelligence. It's also going to be protected from the buffers of geopolitical. We've still got to carry on. We've still got to do stuff. So we'll still make money. And I think, the top headline in a market shaped by AI disruption, this note favors companies that over physical, tangible infrastructure. Okay. So it's almost going back to Chad, if you don't mind me saying, Chad likes the expression picks and shovels. Let's not invest in the actual commodity. Let's invest in the company that wants to sell all those guys who are looking for that commodity a pick and a shovel. So difficult to replicate. These are big cash-intensive businesses. You need a lot of money to start a business to try and topple the ones that we've chosen. Not easily disrupted by AI. They actually leverage off AI. That's one of their advantages. They're actually making money out of AI, huge amounts of money, but they are heavy on the physical asset side. And there's some examples: lands, pipelines, machinery, rigs, infrastructure, etc. AI can optimize all those things, but it can't simply replace them. Okay. Heavy asset intensity, again, grids, plants, rail facilities, a lot of capital to build, a lot of infrastructure to build, a lot of regulations, red tape, etc. We had a energy note a while ago, and we had a Constellation Energy, which is a nuclear energy company in there. And one of the reasons we chose it is it's preeminent, it's strong, it's done fantastically well, by the way. But the question is, competitor, it takes a long time to build a nuclear facility. By the time it gets running, no, it will be finished, and hopefully the company will have done very, very well. And low obsolescence, it's not a fad. It's not something that's left over from some marketing budget, like, let's try and do this. This is huge capital infrastructure. It's a 5 or 10-year plan to deliver this to market, to your shareholders, and to create basically revenue flow. So it needs a fairly low risk in terms of your capex, what's going out, in terms of what's going to come back. It needs to be well balanced in terms of, we're not quite sure what we're going to get back. The bean counters who approve these things will want to know exactly within the margins what's coming back and when. A little bit different to the hyperscalers that we spoke about. So here's some companies. It's in the fact sheet. It's in the rationale. These are the companies. The next slide, if you may. American-based companies. Some of them you might be familiar with. Caterpillar, top right-hand side. We all know about them. We kind of associate them with big yellow machines that move dirt around, which is quite obvious. Some of us buy Caterpillar shoes. But one of the major areas that they're involved in is power generation. And the power generation, just to give you an example, in terms of how they've leveraged off AI, is they had their earnings report on, they had an announcement by their new CEO, started on the 1st of April, 2 days ago. And I'll read it here. It says, Caterpillar reported Q1 2026 revenue. Caterpillar eyes record backlog as data center power demand powers sales outlook. So in other words, they are putting power units, generators, for want of another word, into these data centers that these hyperscalers are building. Okay, so this is the picks and shovels side. So we're looking at granular, what makes the data centers work. They've got to buy the machines. They don't lease them. They buy the machines, and off it goes. It gets paid for. It goes through to the balance sheet. So Caterpillar has been very, very strong as part of the Dow. It's part of the family of, it's called dividend royalty. They've paid dividends to their shareholders for the last 33 years without a miss, and every year it increases. So these are very cash flush businesses, particularly Caterpillar. C.H. Robinson, it's a global company, logistics, moving things all around the world, air, sea, land, you name it. So it's a logistics business, if you want to call it that. They own railway lines, they own airlines, very under the radar, massive, massive company. And I'll take you through a very interesting chart before I hand over to Jill on all these 4 companies. ExxonMobil, we all heard about, been in the news a lot. It's obviously an energy company, but we need their oil rigs. Those are the hard assets. That's the durable assets. We need the oil rigs. We need the piping. We need the refineries. They own all of that. They own the business-to-business end. And yes, very dependent on the price of oil, highly aware and acutely aware of that. But their businesses, all these businesses were chosen because A, they're hugely cash flush, they all pay dividends, and they haven't got massive 142, 150 price earnings ratios. These range between 14 and maybe 34 or 40, I believe. So it's a much compressed range, far more comfortable on a risk-off situation. Then we've got Nutrien, who's probably the most unheard of company, but it's the biggest fertilizer company in the world. We saw what happened to fertilizer prices when Russia invaded Ukraine, one of the biggest fertilizer countries in the world. So, why do we choose Nutrien when you think of AI? Well, AI can optimize your crop, your crop yields and when to rotate, et cetera, et cetera. But what is it made out of? What is fertilizer made out of? It's made out of phosphates. It's made out of stuff that comes out of the ground. Now, AI can't replicate that. It can't replace that. You still got to have mines that produce those phosphates and everything else that goes into a fertilizer. And you've seen the price of fertilizer absolutely shoot up because obviously the Middle East, the Persian Gulf area is a major gateway for the components and the constituents of fertilizer to leave. So if fertilizer prices are elevated at the moment, and you'll see the stock prices as well. Very, very cash flush company as well. Very important. Bottom left, BBVA, delighted that they came on board. They gave us a great rate. There was some fierce competition we had to beat off from some of the other banks who wanted to underwrite it, but we were very comfortable with the coupon they gave us. We thought it was in the right place at the right time. And if we go across now to just some core characteristics of, what is this hard assets? I'm not going to, the next slide, I'm not going to go through it. I'd rather say, have a look through it, read it, because we've really been through it. But one of the words I'd like to hone in on is the second point, a structural moat. These assets, I talk about an economic moat around a business. So if you've got enough cash flow, if you've got enough protection, if you're a preeminent player in your sector, you have started building a moat around your business. So irrespective of high interest rates, of inflation, of stagflation, of all those things that we're possibly facing now, you've got enough cash flow coming in a new business and ongoing business that you can actually go through this lot. Smaller companies will fall, they'll fade. High risk companies who leveraged a lot of debt, they'll probably have to restructure at a great loss. So moats are very important in terms of, let's produce a long-term situation that's going to be around for a long time. The companies that are in this particular moat, this particular basket, should I say, have been around for a long time. You can look at their history, their lineage, they've been around. And I think what's important is that there's always a demand. There's always going to be a demand for energy. Even if you're a data center, you need energy, whether it comes from an oil rig or whether it comes from a Caterpillar, a power generation or renewables, you need power. Okay, so there's always going to be a demand. It is resilient to AI. So if this bubble does prick, if there is things do go a little bit sour on the AI side, they're making a lot of money, as I mentioned. The Caterpillar CEO said they're making a lot of money, but don't be reliant on it and don't be put out of business by it. Just leverage the balance sheet so that you make more money out of it. These are not businesses. None of these are businesses that you can suddenly just say, oh, I'll replicate that next week with a software update. This takes time, money, effort, geographic spread. These guys are all over the world with hard assets in situ, mining, developing, transporting, shipping, whatever it might be, to the rest of the world. So it's a durable concept. And I think that is very, very important. To highlight what Mark Zuckerberg said. He wasn't sure what he was going to do, how much it was going to scale by, how much profit, what product. This is very direct. This is, exactly what's coming where from these companies. They can hone in, the analysts can hone in and say, this section of the business didn't produce the business. Why? As opposed to, we've got 145 billion we hoping is going to make some money for our shareholders. That, to me, as to the analysts, is a little bit disingenuous in terms of where you're actually going. Okay. And why is it trending? Why is people moving into this hard asset vibe? Because, all the money seems to be pouring. If you go to the next slide, please, Joel. All the money is pouring into AI. I mean, you saw it. This is the wow factor. It's just chucking in there like you cannot believe. Cats and dogs. But when the noise gets too loud, that's when the smart money starts transitioning to something saying, yes, we will always be invested. And Cashbox has been invested in all, and is still invested in all those companies, pretty much, in various notes. At various times that we've gone in, we've had autocalls, etc. And I still believe there's absolutely the place for AI. It's going to be part of our lives. It's not going to disappear. But for this particular note, and while we sat on the sidelines, is that it's been so unclear, specifically with the Middle East tensions, is let's find something that resonates, that's, if I can put it bluntly, a little bit more down to earth, okay, where we can address the AI disruption fear. We can look at what happens if inflation and interest rates do go up. These are huge cash flow businesses. I mentioned about some of the big the hyperscalers who are pouring money in. They're having to go to the banks now. They're having to raise debt, okay, which they then got to pay off to fund these projects. These guys are cash flush. It's called free cash flow. It's the most brilliant concept. If you look at any company you ever want to look at their free cash flow on their balance sheet. If it's strong, it's pretty much a good company that you need to have a look at. And then, people are saying to me, well, is there a difference between, is this a defensive play? No, these are growth companies. Defensive stocks would be maybe your banks, maybe some of your mining companies, etc., maybe some of your insurance companies, etc., medical. These are high growth sectors. You look at the chart of Caterpillar, which I'm going to show you next. You'll go, woo, I want that. So let's have a look at that. I did an example for a client, and I decided this is about 2 weeks ago, and I decided to include it in this chart. It's a very, very short chart. It's from October last year, so it's Q4 of 2025, and it includes 2025, first quarter of 2026. We've highlighted the 2nd of March. You'll see it right across for the 4 companies, 2nd of March. That was effectively the first trading day once the markets could open, not the futures markets, but the markets could open in the States following the 27th of February first bombings in Iran by the United States. And you can see everybody kind of had a bit of a hiccup, certainly on the left. What's happening now? Things aren't looking too good. The exception is maybe on the far right-hand side, Nutrien. They had a bit of a dip down, but they've carried on. So what I'm saying is that these companies, to a large degree at the moment, are off their all-time highs. There's a bit of an opportunity, maybe Caterpillar, not because they're still trending up, but the others have had a little bit of a dip backwards in terms of there is a bit of value. But you can see what I think is important is the consistency of low volatility within these companies. Because, like everybody, they thought, okay, this is the end. This is World War III starting out of the Middle East, and it's just going to spread globally. Everything went down, and they've all recovered quite nicely. Now, these aren't AI companies. You saw the stochastics, the chart of those AI hyperscalers. Some of them went down, some of them are. These are pretty much, looking quite healthy. So my point here was like, how would these guys tested during a really testing time? I would say the 2 major points of test in the last, let's call it year, have been the 27th of February this year, when the United States attacked Iran, and the 1st of April last year, when the world got terrified by the United States and the tariffs, and everything there took a big plow down, and then subsequently it's risen. But to go back to that very, very first chart, if you remember, the US markets are almost at all-time highs again. And these are some of the constituents that are riding on the coattails of literally the AI without being directly influenced by them. I don't want to be a Palantir, which might be its last software issue. And suddenly, it's been overtaken by Claude or by Anthropic or by ChatGPT, and suddenly you're in a lot of trouble. Not to say Palantir is a bad company. I've got a lot of time for it. It's got very, very deep roots with the American government, and I could write a whole thing about it in terms of advocating it. But I think in terms of this note, we've tried to put something durable together in both US dollars and sterling that is going to last. Even if there's a peace agreement tomorrow, it's going to last through for the next 3 to 4 years and pay a very healthy semi-annual income. And to that point, I'd just like to thank our structures and the investment bank, because to achieve those sort of double-digit numbers is not easy, okay? Normally, you have to assume quite a lot of risk, okay, to get sort of those double digits, especially in income, because the bank has to pay the income away every 6 months, subject to the T's and C's being approved. So pretty stellar. And the feedback that I had from IDAD, from Graham, was that the banks were really impressed with the composition. They liked it, and there was a bit of a bun fight who was going to underwrite it, but we've gone with a team that we know very well at BBVA. So yeah, I'm delighted. So I've taken up quite a bit of your time. I'm sure there's questions, but I'm going to hand over to Joel to give you the fun stuff now.
Great, guys. So thanks, Andrew. That was really amazing, and I think it was really important to have all of that context before we move forward. So just in terms of the key features that we've included in this note, we have our income trigger, which is required in order to pay those coupons out. This note has a coupon that pays out every 6 months. And on each observation date, the reference basket needs to be at or above 60% of its start value. So the income trigger is set at 60%. If the basket drops below that 60% on an observation date, no income is going to be paid for that period. However, that's when we've brought in the memory feature. So should there be any income that's missed, it's never lost. It actually goes into that memory feature. And then as soon as that basket recovers over the 60% at a future observation date, all your previously missed coupons are going to be paid out in full alongside the current coupon that would be due. We've also got at the end of the term, should the note not autocall, which is mature early, is the capital protection barrier. That is also set at 60%. So as long as the underlyings have not fallen below 60% of their start prices at that final maturity date, you're going to receive all of your capital back. If the basket does, or one of the stocks in the basket does drop below that 60% level, your capital protection, your capital loss is going to be proportional to the fall of the lowest performing stock. So that's a very important thing to remember. The idea of these notes is not to run to maturity, is for them to actually mature early. And that's where we've built in the reducing autocall, where from month 12, which is the second observation, if the basket is at or above the autocall level, your note is going to mature early. You will have received your coupons up to that point and your full capital is going to be returned. With the reducing autocall, we're starting at 100% at 12 months. That's going to reduce by 5% semi-annually. So at 18 months, it's going to drop down to 95%. And then from 24 months onward, it's going to be at 90%. So the autocall level is going to reduce so that it does make it easier to autocall. See what's going on with my thing. There we go. So what does that actually look like? We have our semi-annual observations. There are going to be a total of 8 observations for this period. Our income trigger is set at that 60% level. So what that means is that as long as those underlying stocks stay within this area, your coupon is going to flow at the observation dates. In the event that any of those underlying stocks dips below that 60% income trigger, we've got that memory feature, which is going to hold any missed coupons. Our autocall trigger, as I mentioned, starts at 100% of the start value from 12 months and then reduces semi-annually. Third observation, it drops by 5% to 95%, and then from 24 months, it drops down to 90%, and that is where it will remain for the duration until maturity. And then our capital protection barrier at the end, should there not be an autocall, is set at 60%. So just as a quick example, your note starts, and the first observation, you can see the underlyings are above the income trigger, and they're even above their start value. The second observation, the underlyings drop down. They have fallen below their start value, but they are in that area above the income trigger. So your coupon gets paid out again. Moving on to the third observation, we've now got underlyings that are below that income trigger, and that is where the memory feature comes in. So we have there, no coupon is paid out, but it is held in that memory feature. And this continues because we don't actually know what's going to happen, and that's the beauty of the memory feature, is say it runs for 3 observations and the underlyings still remain below that income trigger. At the 6th observation, you can see in this example, it's now over the income trigger. You'll get your 3 coupons that were missed plus the coupon for that observation. Then the 7th observation in this example, we are at the autocall trigger. The note matures. You get your capital back plus that coupon that gets paid out. In the event, as I said before, is if it doesn't autocall, you'll run to the end of the term where you've got your capital protection barrier that comes into play. So just a quick summary of the note. The issuing bank is BBVA. You've got the ratings agencies there. Your coupon is 14.4 in GBP and 15.1 in USD, and that would be paid out semi-annually on condition that the underlyings meet the income trigger. Your maximum term is 4 years, and that is because we've built in that autocall trigger. Your trigger level is for the income is 60%, and then your autocall trigger starting from 100% from the initial value at 12 months, and that reduces by 5% per period. And then again, it is capped at 90%. Andrew's gone through our reference basket quite extensively. And then as far as your capital protection is concerned, your capital is protected until maturity, be that up to the point where it matures early or the end of the term. At that final observation, that is where the capital protection barrier comes in. Your underlyings need to be at or above 60% of their initial value to keep that capital protected. Our availability, the note closes for investment on the 19th of May or full subscription. We do expect a quick take up on this because we've actually been holding back for quite some time, as you all know. And our notes, literally for the last 6 notes, I think we've actually reached full subscription well before the closing date. So your instruction needs to be with your investment bank and funds cleared on the platform before then. And the minimum investment is either $10,000 or £10,000. So that is the minimum investment for this note. And then for those, as a reminder, how to invest in the note. I know we do have some new people here. You do need a trading platform or a custodial platform. If you don't have one already, just let us know. You can email support@cashbox.global and we can send you some information. We will then provide you, for those investors that are interested in taking up the note, with the ISA number, and which is obviously the unique identifier for the specific security, and then you will instruct your trading platform. We will report to you on the note's performance after every observation so that you know exactly what is happening. And then the ongoing support that we offer is refresher training. There's been a lot of information here. So, and also in terms of how the features work. So we're always happy to do refresher training. Our investor insights come through on the WhatsApp group and through email. If you're not on the WhatsApp group, please join. You'll find it most informative. And then also Andrew does a market roundup every week, which we find is being very, very well received. Logan has designed a fantastic investor portal for us, so our investors can have access to what is going on with their structured note portfolios. If you haven't registered for the investor portal, please drop Logan a mail again, support@cashbox.global, and then we will keep you up to date with new opportunities. Hopefully we won't need to wait so long for the next one. Again, closing date 9th of May, just so that you don't miss out. And with that, I'd like to say thank you for joining us and open for any questions.
Bill, maybe I can ask a question. Can I ask Graham to give his input, what he thinks about it? Because he's been in the trenches with me on this one. I appreciate your comments, Graham.
No, definitely. I mean, again, Andrew, you always cover everything off so well, but I think, just to maybe add a little bit of a smile on people's faces to add into the pot here. I've actually put quite a few questions on the whole concept of what this note is into AI, into ChatGPT, and the amazing thing is that it's concluded. I mean, I won't go through all of the blurb that it's done, but it has done a bloody good job actually of analyzing the note. And the conclusion is a smarter way to think about this whole concept is ask yourself, would I be comfortable owning the worst of these 4 stocks with the potential of the stock dropping more than 40%? If the answer is no, then this is not for you. Now, I mean that I know we are all pretty good on structured notes at the moment. I know there's a lot of familiar faces on the call, so I know that people are really hooked into this and have an excellent understanding. But that really is the crux of everything. It's everything that we do. It's, if I look at those 4 stocks, And I think to myself, well, which one would be the worst one if I was to buy them directly? Would I be comfortable holding it? And that's where, and this is where AI has really cut to the chase, because this is it. I mean, pick any one of those stocks, and over a 4-year period, would you be comfortable with the risk of holding it and it not losing more than 40%? And for me, it works. And therefore, AI is saying, well, if you're comfortable with that, then this is for you. Because again, I won't go into all the blurb, but the return that we're actually providing in this note that you've actually driven out, and I must admit a little bit of arm wrestling with BBVA in dollar terms at 15% per annum, then yeah, it wins. So that's just a little bit of a smiley look on the sense that you've done fantastic analysis of AI and why that is. Is it a bubble? Is it not a bubble? The 700 billion that they're going to be spending next year, and etc. But here we are with something that the acronym HALO shows us that there is a basket of stocks that you can put in a note in these current times that you can feel is a solid investment, and understanding the risks, of course, as always, but knowing that you have an investment over a 4-year term period that is going to deliver exceptional coupons with a strong downside control of risk. So yeah, that's it for me, really, Andrew. To add to what you've done here, which is again another great note.
Yeah. There's a question, Graham, in terms of the protection barrier being raised. We normally go for 50%.
Yeah.
And this barrier is now at 60%. And the question is, does that imply that there is higher risk by going 60%?
And
I think it's actually, it's actually counterintuitive, because at 60% there's probably less risk to the bank.
Less risk to the bank, but
yeah,
I mean, in simple maths, yes, of course, the higher that Cashbox puts that protection barrier, then statistically, and again, past performance is not the definition of future performance, but statistically, then the higher the barrier, the increased risk of the barrier being breached. I can pick one example for, off the top of my head, as far as the oil sector is concerned, then yes, I mean, there have been moments in history whereby that sector has had a significant reduction in balance sheet values for companies. So therefore, yeah, there is relatively a higher risk. I mean, if we could hit let's say a 40% capital protection barrier, wow, you've got to drop 60% before you start losing money. It's just a simple mathematical and statistical analysis that shows that, yes, we have upped that by 10% from the 50 to the 60. But, and this is always the but, the ability for Cashbox to project that coupon to the level that they have in GBP and USD terms has been, I believe, the right way to go for this note, particularly with what you've analysed, Andrew, in the macroeconomics that we're in. For example, if Cashbox had gone another 10-20% higher capital protection barriers, then with a basket of different stocks, let's say, for example, AI stocks, then I would have said that that increased risk of capital loss for the return in the coupon doesn't marry. Whereby here, I think what you've done with that 10% movement from 60 from 50 to 60%, the capital protection barrier is definitely worth it with regards to the coupon and the basket that you're looking at. So yeah, there is, without question, you have to say, yes, there is an increased risk, because if you put the capital protection barrier at 90%, then you've only got a 10% loss scenario before you're losing nominal. But the coupon would have been double digit. Sorry, it would have gone into
single digit.
No, the coupon actually would have gone up. Because the lower the capital protection barrier costs in coupon. The more protection you give, the lower the coupon. The higher protection you put on the capital protection barrier, as in the up towards 100%, it costs you in the coupon.
Yeah, so the coupon would have gone down.
Yeah.
So essentially, Pierre, just quickly, when one creates a structured note, the bank is happy to talk at different levels, like Graham is saying. And it all works out in terms of the T's and C's of the product, in terms of, okay, how much do you guys want? Do you want 15%, 14%, 12%? And what do you want for protection? And what do you want to trigger the income? So you've got these parameters, like a big ball of clay that you're playing with, and you're molding it into a shape. And ultimately, the shape gets to a point where you think, okay, well, that seems reasonable. The coupon is attractive. The protection barrier is attractive. There is some, obviously, risk. And, to your question, I would say possibly the risk lies in the fact that if you want to talk increased risk, there's an oil major in there, ExxonMobil, and we don't know. I mean, as I mentioned, the oil price has been driven by headlines at the moment. We wake up one morning and the price is $125 a barrel. In the afternoon, it's $199 a barrel. So it's moving rapidly on the narrative of tabloids and social media, because I heard something interesting this morning. Diplomacy in the world now it's basically social media narrative. Everybody puts out their thoughts on X or Truth Social, whatever it might be. So, these high-powered meetings don't happen, or you have to schedule a meeting. No, they just Google on their phone, this tweet on their phone, or X on their phone, or whatever, and off you go. And suddenly markets go left and markets go right. So it is generally a situation where, oil probably is the bit of a wild, if you want to call it a wild factor here. But oil's not going away. Hydrocarbons are not going away. We've all seen what's happened with renewables, and oil drives the world at the moment, and the world needs oil. I mean, just go down to the petrol station. We all know, we're all feeling the pain. So, yeah. But I think 60% is reasonable, because these are heavyweight companies. These are big companies. And we felt comfortable at that 60% level. A 60% income trigger and a 60% protection level sort of balances out nicely.
But a good question, a very, very good question, because those are the three principal parameters that we are constantly balancing: the capital protection barrier, the coupon, and effectively the memory income trigger. So it's a very good question, but it's also very important that we balance them all sensitively in context. Somebody's
Eric,
put there.
Eric, you've asked the question: what level do the shares start? We have a starting date. There is a term sheet. You can see it on the invite earlier. There was an access to a fact sheet. On the fact sheet, they will have what's called issue date. The issue date is the starting date. So literally on that date, we will take the prices.
No, sorry, Andrew. Can I just interject there? The prices start at the strike date.
I beg your pardon, the strike date. Yeah.
So on the 22nd of May. The prices will be locked in, and then effectively that's the starting line. That's the starting line.
The issue date is the when it actually gets issued and running. It goes live.
Yeah.
Beg your pardon.
Thank you.
No worries. No worries.
I've just got a question. Hi, everyone. I've got a question in terms of CH Robinson. I saw about a day or so ago with Amazon, I think they're opening up their logistics network to third party or something along those lines. And I saw CH Robinson's share price dropped 9% more or less on that day. And, I read the analysts saying that it was maybe a trigger or a panic in the market, and then it will stabilize. How does that affect, CH Robinson's, share price and future going forward with Amazon now maybe being their competition in some way?
Yeah, Dimitri, there's a lot to be said for, a lot of the big portal providers, whether you be Amazon, whether you be eBay, which is also under consideration at the moment in terms of how do you deliver goods to people. CH Robinson is a physical deliverer of goods. So it owns railways, it owns tracks, it owns trucks, it owns airplanes, etc. It's got, in terms of the analysts, what Graham and I often do is we look at analysts' estimates. Now, analysts can change their minds literally, like they can go a bit like Donald Trump, I guess. They can go into the toilet and come out and have a different view completely. Excuse the example, but at the moment they've got typically, I'm just looking on my screen, what's called a growth style score of A. So their earnings, I know, is their earnings for 2026, the balance of 26 is 18%. So 18% growth on where they are currently is pretty good. I mean, the analysts, these boffins, we call them boffins, they've revised their earnings estimates upwards in the last 60 days, irrespective of what's happening with Amazon. Obviously, there are these events like an Amazon coming along and saying, we're gonna directly challenge you in this particular space. And obviously, people say, "Oh, hang on, Amazon have got a far bigger urban network than maybe CH Robinson." CH Robinson is in the macro space, I would say, in terms of massive deliveries by ships, airplanes, and rail, as well as local deliveries, whereas Amazon has worked more organically from starting out delivering to local towns, local villages, local cities, local boroughs into the global space, and establishing hubs, geographically around the world, which they're very, very good at. It's a case of what is your knitting and are you sticking to it? Because Amazon has got a lot of fingers in a lot of pies. One of those pies is artificial intelligence. The logistics company is saying, we deliver goods globally, and we will leverage off AI. They can optimize our plans. They can optimize how we deliver things from A to B. But we're certainly not going to be involved in terms of them redefining our business in terms of, okay, you guys can't do something. Put it this way, Amazon needs trucks as well. It needs delivery vehicles. It needs robo-taxis. It needs all that kind of stuff. It needs airplanes to deliver. So it's a case of saying, I've got a bigger distribution network than you. It's like Pepsi turning to Coke and Coke turning to Pepsi, saying, I'm better than you. Vodacom and MTN in South Africa. It doesn't matter where you go. Tesco's versus Sainsbury's. People have got different views in terms of how you're going to take market share. Analysts, and those are the guys who drive a lot of the price movement on a daily basis in terms of buy and sell orders, can definitely move markets. But I would rather say a one-day aberration, and DeepSeek was not an aberration, 17 or 36% down, whatever it was not an aberration. It was actually a real test of where that particular trend is. So they were testing trends. I think, we all have bad days. We looked at some of those charts where we saw Palantir, go down, it came back up again. We've seen Nvidia lost $600 billion